Covered call is a very popular option strategy. It is easy to understand, simple to do, and once you master it, it can give you a steady stream of passive income every month. That's why in this video, I'll be covering the basics of everything you need to know about selling covered calls, including what's a covered call, how does it work, how to sell a covered call, how to close the position. Finally, I will also be sharing some tips and tricks on how you can increase your profitability while managing your risk. And with that being said, let's jump right in. So let's start with a quick overview on how to do a covered call. Step 1. You need to own 100 shares in order to sell one covered call. This is because when you sell a call option, you are basically promising that you'll be selling 100 shares at the strike price on or before the expiration date. And if you sell a call option without owning 100 shares, that's called selling a naked call. It can lead to huge losses. So don't do that, yeah? You don't want to be caught doing naked stuff, especially in public. Step 2. Sell the call option, and by doing so, Step 3. You get paid a premium from the options buyer. And finally, Step 4. Pray that the stock price stays below the strike price. If that happens, congratulations, the option will expire worthless. But if the stock price goes above the strike price, you have to sell away your stock at the strike price. So that's covered call. The idea behind it is very simple. You want to choose the strike price that you do not think the stock will reach by the expiration date. If it doesn't reach, you win. So simple. Alright, let's take a look at an example now. Let's say I've bought a stock that's at $100 and I don't think that the stock will reach $110 in a month's time. In that case, I can sell a covered call at a strike price of $110 and an expiration date that's 1 month away. By doing so, I'll get paid a premium by the options buyer. The premium will come into my account the moment I sell the option. The money is mine now, and I can choose to do whatever I want with the money. Let's say the premium is $3, but because each option contract represents 100 shares, I will get to collect a total of $300. Now, one of the two things can happen. First, the stock price stays below the strike price by the expiration date. This is also called expiring out of the money. When that happens, we will get to keep all our stocks and the premium that we have collected. Second, if the stock price goes above the strike price, this is called expiring in the money. When that happens, we will still get to keep the premium that we have collected, but this time we have to sell 100 stocks at the strike price. And here's where you will see the biggest risk of selling covered calls. In this example, the stock only reaches $112 and we are forced to sell at $110. This means we have missed out on $2 times 100 shares, or $200 worth of potential profits. But that's still okay because the $300 premium that we have collected is still higher than the profits that we have missed. However, the problem is when the stock suddenly goes to an even higher price, like $130. In this case, we have missed out on an entire $2,000 worth of potential profits, or $1,700 if we take into account the $300 premium that we have collected. Okay, if you are a visual kind of guy or girl, here's a profit loss chart to help you better visualize this. At the top, you can see that the max profit is at $13. This $13 came from the stock going up by $10 plus the $3 that we have collected from the premium. If the stock continues going up further, the profit will still be capped at $13. The break-even price is $97. This is because we bought the stock at $100, but because we also collected a $3 premium. Our cost basis for the stock has been lowered to $97. After that, the lower the stock goes, the bigger our loss, until the stock eventually goes to zero. Now, of course, in reality, the chances of the stock going to zero is extremely small, unless you are YOLOing with crazy meme stocks. That's why the number one rule of owning any stock is to own stocks that are good. Yes, that sounds simple, right? But apparently, some of us seem to be having trouble following this rule. Now, here's a question. How do we balance between choosing an option that's far away to avoid going in the money and yet not too far away that we still can collect a decent amount of premium? The first thing we can look at is delta. Check this out. Here are some call options for Tesla. At the $265 call, the option has a delta of 0.283. Delta is often used to approximately measure the probability that the option will go in the money. So that's about a 28% chance that it will go in the money. Or in other words, a 78% probability of profit, which is rather high. And by selling this option, we get to collect about $480 premium. Then if I scroll further, you can see that the further out of the money we go, the lower the delta, and the lower the bid price until the premium eventually drops to just 1 cent. While selling option at this level basically gives you an almost 100% chance of profit, you don't want to sell at this level because you are capping your entire upside potential just to earn $1, which doesn't make any sense. And that doesn't even take into account the commission fee that you have to pay. According to studies done, the recommended delta is to go for around 0.3 delta. This means the option will only have a 30% chance of going in the money or around 70% chance of profit. This gives you the best balance of reward for the risk that you are taking. Second, it's better to choose an option that has a longer expiry date. But then you might ask, isn't it better to choose an option that has a 1-week expiry? That way, the option will expire a lot sooner and you'll be exposed to less risk, right? Well, yes, but no. That's because 1. If you go for weekly options, there's barely any extrinsic value left. This means your main strategy here is to just wait for the option to expire out of the money. But if you go for options with longer expiry, the option will have more extrinsic value for you to collect. Second, assuming you are choosing strikes at the same delta, the strike price of a longer dated option is further away from the stock price as compared to a weekly option where the strike price is closer to the stock price. This means for longer dated options, if the stock suddenly goes against you, you will have more time to fix the trade, whether it's by hoping that the stock goes back down or by rolling the stock to a higher strike price. That's why when selling options, the recommended expiry date to go for is around 30 to 45 days to expiry. But with that being said, these are not hard rules, yeah. They are just there to serve as guides as to how you can optimally earn from selling options. You can adjust the expiry dates and delta depending on your preferences. Now, let's put this into practice. Here, I'm using Interactive Brokers, but the steps will be similar on other platforms. I'll be selling a call option on Tesla. To do that, I can click on the options button to open up the options chain. The first thing that I want to do is choose an option that is further out in time, so there's more extrinsic value. Let's go for January 12, 2024, which is about 30 days from now. Next, I won't be going for the 0.3 delta. Instead, I will go a little further to 0.12 delta, as Tesla is a lot more volatile and I want to give it more room just in case it goes up. Next, I can click on the bid price to create a sell order. For quantity, I will just leave it as 1 since I want to sell 1 option contract. For order type, some people recommending using limit order. Then set the limit price to the mid price between bid and ask. But personally, I won't really bother too much since the difference between bid and ask is quite small. So I'll just go for market order instead. One other useful feature is that IBKR also lets you attach another order on top of this order. So if you want to take profits early, you can enable profit taker to maybe close your position at the 50% profit. Once you are ready, you can click on preview, check your order to make sure you have selected the right expiry date, strike price, and most importantly, you are selling an option instead of buying. If everything is alright, just click transmit order. Then to check your order, you can head over to trade, orders and trades. Then you will see your order here. In my case, the order is still at $1.78. So I've collected $178 in premiums. Now, let's talk about closing your position. While it's nice to wait for the option price to drop all the way to 0 and keep 100% of the premium, in most cases, it's not the ideal way to do it. 2 reasons. 1, let's say you have sold an option that has an expiration of 1 month. By next week, the option has dropped to 50% of its value. Instead of waiting 3 more weeks to earn the remaining 50%, it is much more efficient to close the option and sell a new one to earn another round of premium. And also, as long as the contract is still open, you will still have an obligation to sell the stock. So by closing the option early, you are locking in your profits and will no longer have the obligation to sell the stock. The other reason is that options that are out of the money tend to decay slower. You might have seen graphs where the closer the option gets to expiry, the faster the decay. But that's only if the option is at the money. In reality, if the option is out of the money, the decay actually slows down the closer the option gets to expiry. Now, let's check out how to close an option. Here, I've sold 5 Tesla calls at the $280 strike price. The average price is at $2.74. But now, the option price has dropped to $1.80. So that's about 34% profit. This is the part that gets many people confused, where they think that unrealized profit and loss affects the premium that they have collected. No, that's not the case, yeah. Remember, I've already collected the premium beforehand. So if I decide to do nothing, this unrealized profit and loss doesn't affect me, as I get to keep the premium that I've collected. But if I want to close the option early, I will have to pay $180 to close one contract. So to close an options contract, you can click on the 3 dots on the right, then click close. Everything is the same here. You can enter in how many contracts you want to close, set the limit price, order type, click preview. Then submit your order and you are done. Finally, here are some tips on how to maximize your profits while reducing your risk. 1. Always make sure that the option is covered. The last thing you want is the stock goes against you and you end up with a huge loss. If you don't have enough money to buy 100 stocks, you are poor lah. Just kidding. If you don't have enough money to buy 100 stocks, there are other option strategies which you can use to make it covered, such as credit spreads or poor man's covered call. 2. Covered call works really well when the stock doesn't move much or if it's going down. The worst situation you want to be in is when you sell a covered call and the stock suddenly goes up and you end up missing out on all the gains. So to minimize that from happening, you want to avoid selling calls right before any big announcements that may hugely affect the stock price, such as earnings calls. One very useful tool that you can use is a website called Options AI. It can show you what happened during the past few earnings. In this case, Tesla has either moved up or down by 10% within a day. And that's super scary, yeah? You can also see when is the next earnings date. It even shows you how far the stock might move depending on its current IV. Last but not least, try to pay attention to technical indicators. If you are like me, you will start at reading stock charts. But don't worry, because IBKR has something that makes analyzing charts a lot easier. So to find it, click on Research, Discover, Technical Insight, then look for the stock you want to analyze. Here, you will find a quick chart analysis for the short term, intermediate term, and long term. For example, for the short term, there was a price crosses moving average event, which is a short-term bullish signal. In the intermediate term, there's also a similar event. Then, if you scroll down, you will see different support and resistance for the stock depending on which period you are in. If you tap on them and tap on the bell icon, you'll be able to add an alert to notify you when the stock reaches the price. So that was a quick introduction on how to sell covered calls. The whole idea of selling options isn't to get rich quick. It won't happen here, yeah. Instead, it is to make small consistent gains, which over time would add up. It's important to keep a record of all your options trades so that you will know what works, what doesn't work, and slowly make adjustments along the way. I have a free options spreadsheet if you need a way of keeping a record. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.